Let's start with a daydream you've definitely had. You're looking at the chart and you see it. The perfect setup. The once-in-a-year alignment of trend, news, and a pristine technical level. Your pulse quickens. You imagine the outcome entering with substantial size, the market soaring in your direction, the profit counter climbing into territory that would cover months of grinding. This is it. The home run trade. The one that validates all your struggle and changes everything overnight. This fantasy isn't just appealing, it's intoxicating. It's also the single most destructive force in your development as a trader. Here's the brutal truth the gurus selling you dreams of Lamborghinis won't tell you. Your obsession with the big win is not a strategy. It's an emotional bypass. It's a desperate subconscious attempt to skip the grueling, unsexy daily work of building real, sustainable skill. You're not seeking a trade, you're seeking a narrative arc, a story of heroism, struggle, and ultimate redemption, where one brilliant decision erases all past failures. The market, however, doesn't care about your story. It's a probabilistic machine and it punishes those who trade based on cinema, not statistics. Think about what this fantasy does to your trading psychology in real time. When you're hunting for the home run, you become allergic to taking small, rational profits. A trade goes up 2%. It could be 10%. This might be the one. So you move your stop to break even, then watch the trade reverse and hit it. You've just turned a winner into a loser, fueling the frustration that makes you crave the next big score even more. It creates a vicious cycle where small wins feel like failures because they don't match the epic movie playing in your head. Worse, this mindset makes you a prisoner of your P&L. Your confidence, your self-worth, your daily mood become tied to the hunt for that seismic payoff. The quiet satisfaction of a week of 0.5% gains feels meaningless. The boredom of discipline becomes unbearable. So you start forcing setups that aren't there, increasing your size prematurely, and holding losers just in case they turn into the monster win. You abandon your process because the process feels too slow. The dream of the big win, therefore, systematically dismantles the very habits required to achieve long-term success. This is the first and most critical trap to recognize. You must see the fantasy for what it is, a siren song luring you onto the rocks of inconsistency and emotional turmoil. The path to profitability isn't paved with heroic, all-or-nothing stands. It's paved with the quiet, repetitive discipline of collecting small, unglamorous wins day after day. It's time to kill the hero and become the architect. That fantasy of the home run trade doesn't live in a vacuum. It's a symptom of a deeper, more dangerous psychological framework. The belief that your trading success hinges on one perfect setup. It's the just one good trade mentality, and it's a poison pill for your discipline. This is how it shows up. You've had a string of losses or a flat period. Frustration builds. The voice in your head shifts from strategic to desperate. It whispers, just one big winner. That's all I need to get back to even. That's all I need to prove I'm right. Suddenly, your goal is no longer to execute your process correctly. Your goal is salvation. You're no longer trading to trade well. You're trading to feel better, to solve an emotional problem with a financial outcome. This mindset is the gateway to every cardinal sin in the trading book. Why? Because it makes you negotiate with your own rules. When you're hunting for the one big score, a good setup morphs into a perfect setup in your mind. You start ignoring crucial risk parameters. You think, this one is special, I can risk a bit more. You hold winning trades far past your profit target. Greed whispering, this could be the one, don't sell yet. You hold losing trades even longer. Hoping turns into praying because accepting a small loss feels like admitting the big win won't come today. Your mentor saw this in me before I did. You're not looking for an opportunity, he told me after a particularly reckless session. You're looking for a savior, and the market doesn't do salvation. It only does probability. He was right. I had moved my stops, doubled my size, and abandoned my entry criteria, all in service of a story where one trade would redeem my week. The real cost of this mentality isn't just the monetary loss from those impulsive trades. The real cost is the erosion of your process. Every time you break a rule chasing the ghost of a big win, You weaken the neural pathway of discipline and strengthen the pathway of emotional desperation. You train your brain that the rules are optional when the stakes feel high. This creates a terrifying inconsistency. You can follow a plan perfectly for 10 small trades, then blow the entire profit on one undisciplined, emotionally charged hero play. This is the most seductive lie. The belief that intensity can replace consistency. You think, if I just focus harder, want it more, risk more on this one, I can shortcut the grind. But trading doesn't reward intensity of emotion. It rewards the consistency of execution. A single, frantic, all-or-nothing effort cannot compensate for the quiet, daily work of following a plan. 10 hours of desperate, rule-breaking screen time will never yield the results of 30 minutes of calm, disciplined, rule-based trading. The just one good trade mentality makes you a sprinter in a marathon, burning all your energy in a chaotic dash for a finish line that doesn't exist. Therefore, the first step out of this trap is to change your definition of a good trade. It is not a trade that makes a lot of money. A good trade is a trade that follows your plan. Period. A small win where you respected your stop and took profit at your target is a masterpiece of discipline. A large win that came from breaking every rule you have is a disaster in disguise. It reinforces the exact behavior that will destroy you in the long run. You must learn to celebrate the former and be deeply suspicious of the latter. If you think the damage from a big win is just psychological, you're only half right. The real sabotage happens at a chemical level, deep within the wiring of your brain. Understanding this is crucial because it explains why that one great trade doesn't just boost your account, it systematically reprograms you to fail. The culprit is dopamine, not the gentle drip you get from a job well done, but the explosive, addictive flood that comes from an unexpected large reward. When you hit a massive, quick profit, your brain doesn't process it as a logical outcome of a process. It processes it like a slot machine jackpot. It releases a tsunami of dopamine, creating an intense, euphoric high. This isn't just a feeling, it's a neurological event that rewires your reward system. Your brain's primary directive is to repeat actions that lead to survival and reward. When a high-risk, high-reward action, like a large, emotionally charged trade, results in a dopamine deluge, your brain stamps it with a giant "do this again" label. It creates a powerful, subconscious connection between reckless behavior and intense pleasure. This is the exact same mechanism that fuels gambling addiction. The trader who scores a huge win isn't just lucky. They are, in a very real sense, becoming chemically addicted to the pattern that created it. This is where the poison takes effect. After the high, your brain's dopamine baseline resets. Your normal trading, the disciplined, process-oriented, small-win approach, now feels boring and unsatisfying. It doesn't deliver the same chemical payload, so you begin to subconsciously seek out that high again. You start to misinterpret the market. A moderate setup starts to look perfect because your brain is craving the reward it associates with big moves. You increase your position size, not from calculated risk assessment, but from a chemical craving for intensity. You become bored with good discipline and aroused by dangerous risk. A trader in our community, Mark, lived this. He caught a perfect short on a news spike, making a month's target in 20 minutes. He was ecstatic. For the next 2 weeks, he was a ghost of his former disciplined self. He complained that the market was slow and not moving. What he really meant was that it wasn't moving enough to replicate his high. He started forcing trades into quiet ranges, taking shots at tiny moves with oversized lots, trying to chemically recapture that feeling. He gave back the entire win and more, not because he forgot how to trade, but because his brain had been hijacked by the memory of a chemical reward. Therefore, a big win isn't a milestone. It's a trap disguised as a trophy. It teaches your brain to value the wrong things: the size of the payout over the quality of the execution, the intensity of the gamble over the consistency of the process. It makes you chemically dependent on volatility and luck, the two things you can least control. Your discipline, which is built on patience and repetition, gets chemically downgraded in your own mind. The path forward isn't to avoid wins, but to detox your reward system. You must learn to derive your dopamine hit from the flawless execution of your plan, not from the number in your P&L. A perfectly taken 0.5% gain where you followed every rule should feel better to your brain than a chaotic 5% win where you broke them. You have to retrain your neurology to fall in love with the process, not the outlier. Because if you don't, your own brain chemistry will become your most relentless opponent, constantly pulling you towards the cliff's edge in search of another chemical thrill. It's time to move from psychology to physics. The cold, unemotional laws of mathematics prove why the pursuit of small, consistent wins isn't just a good idea. It's the only sustainable path to growth. The single greatest force in trading and investing is compounding, and it requires one non-negotiable ingredient: capital preservation. This is where the big win hunter fails catastrophically. Let's prove this with the story of two traders, Alex the architect and Sam the sniper. Alex the architect plays the long game. His goal is a steady 1.5% return on his risk per trade, aiming for a net 3% growth per month. He risks 1% of his $10,000 account per trade. His equity curve is boring. It's a slow, almost imperceptible staircase upwards. He has losing weeks, but they are shallow because his risk is controlled. His wins are small but frequent. Sam the sniper is hunting for the big kill. He believes in his skill to catch the one big move. He sits on the sidelines for weeks, then commits 10% of his $10,000 account to a single high-conviction trade. Sometimes he hits it, gaining 20%, $2,000 in a day, a massive spike on his chart. He feels like a genius. Other times he misses, and that 10% loss, $1,000, creates a deep drawdown. His equity curve is a dramatic, heart-stopping roller coaster of steep peaks and crushing valleys. Now, let's fast forward one volatile year. Both face three major losing streaks where markets are chaotic and their edge disappears. Alex, with his 1% risk, navigates these streaks. A bad month might see him draw down 5%. It's uncomfortable but not catastrophic. His capital remains largely intact, allowing his consistent small wins to compound when conditions improve. His account might end the year at 14,200, 42% gain. Sam, however, takes his big shots during these volatile periods, convinced he sees an opportunity. One bad streak with two of his 10% bets going against him wipes out 20% of his capital. He now has $8,000 to work with. To get back to even, he doesn't need a 20% gain. He needs a 25% gain just to recover his losses. This psychological pressure makes him take even bigger risks, often leading to the dreaded death spiral. His year-end balance is a coin flip, statistically favoring ruin. The math is merciless. A 50% loss requires a 100% gain just to break even. A series of small wins protects you from this devastating arithmetic. A single large loss from an oversized hero trade can cripple your account's ability to recover, destroying years of compounding progress in one impulsive move. Therefore, the goal shifts from seeking the largest possible win to ensuring the smallest possible loss. Your profitability is defined not by the height of your wins, but by the shallowness of your drawdowns. Small, consistent wins are the bricks that build a fortress. A big win is a fireworks display, spectacular, temporary, and it leaves you in the dark afterwards, chasing the next flash in the sky. The conclusion is inescapable. You cannot argue with compound interest. It is the most powerful force in finance, and it sides unequivocally with the patient, the consistent, and the risk-averse. Chasing big wins is a declaration of war against mathematics itself. And in that war, you will lose every single time. The true big win isn't a single trade. It's the geometric growth of your capital over time, built patiently, one small, disciplined victory at a time. The philosophy is clear. The math is undeniable. Now we build the machine. Transitioning from a big win hunter to a small wins architect requires a complete system overhaul. It's not about trying harder. It's about installing new rules that make disciplined consistency, automatic and emotional gambling impossible. Here is your 4-pillar blueprint. Pillar 1. Redefine your goal from dollars to percentages and process. You must surgically remove your ego and emotions from your target. This means eliminating absolute dollar figures like thinking, I need to make $500 today, and replacing them with percentage-based objectives tied to your account equity. Your primary daily goal is no longer a profit number. It is this: execute my trading plan flawlessly on every single setup that meets my criteria. Your secondary weekly goal is a modest percentage gain. For example, 1 to 3% of your capital. This reframes success completely. A day where you took one perfect trade that lost 0.5% is a successful day because you followed the process. A day where you broke your rules to scratch out a 2% profit is a failure that must be journaled and analyzed. Pillar 2. The power of ritual, celebrating execution, not size. Your brain needs new dopamine triggers. You will build these through non-negotiable pre-trade and post-trade rituals. Before any trade, you must physically write or type your plan, the entry, stop loss, take profit, and the exact reason for the setup. After the trade closes, you journal the outcome with a mandatory focus. You do not write, made $150, nice. You must write, followed plan perfectly, entry was at confirmed level, stop was respected. Good discipline. Or violated plan by moving stop loss. Outcome is irrelevant. This is a critical error. You are chemically rewiring yourself to derive satisfaction from the checkbox of discipline, not the random outcome of price. Pillar 3. The luck quarantine, a mandatory cool-down protocol. This is your most important rule to prevent the big win poison we discussed. You will institute a mandatory trading break after any single trade that returns a profit greater than a set threshold, for example, 3% of your account. This is non-negotiable. If you hit this threshold, you close all platforms for a minimum of 48 hours. This does two things. First, it physically prevents you from immediately gambling with the market's money in a state of dopamine-induced overconfidence. Second, it symbolically teaches you that a large win is not an invitation to play harder, but a signal to step back and recalibrate. You treat a large win as a potential system risk, not a reward. Pillar 4. Worship the equity curve, not the candles. Change your primary screen. Your most important chart is no longer the 1-hour candlestick chart of your favorite pair. It is the chart of your account's equity curve. This is your report card. Your sole objective as a trader is to make that line go smoothly from the lower left to the upper right of the screen. Every small win is a tiny upward step. Every controlled loss is a shallow, manageable step sideways or down. A volatile, spiky curve is a badge of shame, signaling emotional trading and oversized risk. A smooth, ascending curve is a badge of honor, proving you are a risk manager first and a speculator second. You make decisions not for the next candle, but for the next inflection point on this chart. This system is not exciting. It is administrative. It is bureaucratic. And that is its supreme power. It transfers the burden of success from your fallible emotional willpower to a rigid, unemotional framework. You are no longer a hero trying to conquer the market. You are a compliance officer ensuring your one-person fund follows its own rules. When you implement this, you stop trading for the story of a big win and start working for the truth of a growing account. The small wins cease to be boring. They become the satisfying individual brushstrokes in a much larger masterpiece of your own creation. This is where it all converges. We have dismantled the fantasy, exposed the lies, understood the chemistry, proven the math, and built the system. Now comes the final, most profound step, the permanent change of who you are in the market. You're not refining your strategy. You are executing an identity transfer. For years, your subconscious identity has been that of a gambler. The gambler's core beliefs are, success is a matter of finding the right opportunity. My brilliance is validated by big scores, and my capital is ammunition for the next big shot. This identity is fed by hope, fueled by emotion, and measured in sporadic, dramatic events. It is exhausting and utterly unsustainable. The system of small wins is not just a set of rules. It is the training manual for a new identity, the architect. The architect's core beliefs are: success is a matter of executing a proven process. My discipline is validated by a smooth equity curve, and my capital is the foundation to be protected and compounded. This identity is fed by preparation, fueled by patience, and measured in steady, predictable growth. This shift is everything. When you are the gambler, a losing trade is a personal insult. It triggers revenge, doubt, and emotional chaos. When you are the architect, a losing trade is statistical feedback. It triggers journaling, review, and a calm adjustment of the blueprint. The gambler fears boredom and craves action. The architect fears randomness and craves order. The gambler watches candles, hoping for a sign. The architect watches his equity curve, managing a project. Your entire relationship with the market transforms from a battle to be won into a landscape to be navigated. You are no longer fighting the market to prove your worth. You are using the market's inherent volatility as raw material for your building project. The noise that frustrated the gambler becomes meaningless to the architect, who is focused on the integrity of his structure, not the daily weather. Adopting this identity is the ultimate act of power. It means taking 100% responsibility for your results, not by blaming your analysis, but by owning your discipline. The market's movements are no longer good or bad. They are simply data points. Your job is not to predict them perfectly. Your job is to have a system that harvests small, consistent gains from its flow and weathers its storms with minimal damage. You trade not to feel alive, but to build something that lasts. This is the true victory that small wins offer. It is not a financial result, but a psychological liberation. You are freed from the emotional roller coaster. You are freed from the anxiety of the next big trade. You are freed from the identity of someone hoping to get lucky. You become a builder, a professional, an architect. And with that identity, the profits are no longer a desperate goal. They become the natural, inevitable byproduct of who you have chosen to be.